Hey guys, welcome to the Investment Club, and of course, welcome to episode 3. Today we're going to have a little discussion on what to look for when investing in companies. Basically, how to pick stocks. When looking to invest in a company or companies, there are key metrics that require attention, and in this video we'll cover those key metrics that you as an investor should have a look at before you decide what company to invest in. The first metric we'll have a look at is earnings growth. Is a company producing consistent earnings? That is a company's profits increasing year on year? This is a helpful indicator to see where their company is progressing towards the future, or if the company has currently found itself in a struggling situation. The second metric we'll have a look at is the company's relative strength in the industry. We can perform a Porter's 5 forces analysis, which incorporates 5 different forces, i.e. power of the buyer, power of the supplier, level of rivalry in the market, threats of new entrants to the market, and the availability of substitute products. So once we perform this analysis, we can determine what the company's competitive position is within its industry. A company that finds itself in a good competitive position or a competitive advantage is a good indicator that the company is likely to be a strong performer within that industry. The third metric is the debt to equity ratio, which is a very important ratio that cannot be overlooked by any means. Mostly, all companies will carry debt, and it's important to determine the amount of debt that a company carries on its balance sheets, because this will translate to the risks involved when investing into that company. A company that carries more debt will inherently carry more risk. It's important that you should invest in a company whereby the assets outweigh its liabilities. Depending on what type of investor you are, will determine the level of debt to equity that you as the investor can accept. For example, if you consider yourself as a risk-adverse investor, meaning that you prefer safe investment, you're not too fond of risk, you would ideally look for a company that has a debt to equity ratio of 0.3 or lower. If you have a higher risk tolerance, which normally the younger aged investors have, you could look for a company that has a higher debt to equity ratio than 0.3. But it's very important to understand the balance between debt and equity. You do not want to invest in a company that is carrying too much debt, because the risks will outweigh the reward when investing in that company. The debt to equity ratio, however, can be misleading if you do not know what industry the company that you are investing is in. For example, companies within the construction industry will have higher debt to equity ratios because of the nature of construction companies. Firstly, they require large initial capital for machinery, and secondly, projects can take months or even years to complete. Thus, construction companies will have higher debt to equity ratios, but this does not necessarily mean that these companies are riskier investments. So, to summarize the debt to equity ratio, a lower ratio tends to coincide with lower risk. However, some industries can have higher debt to equity ratios, but not necessarily imply more risk. The fourth metric we'll have a look at is the price earnings ratio. The price earnings ratio is calculated by dividing a company's stock price by the company's earnings per share. The price earnings ratio is a good metric for comparing companies within the same industry. A higher price earnings ratio typically indicates that investors expect higher earnings, which may seem good. However, a higher price earnings ratio could indicate that a company is overvalued. And as an investor, you do not want to invest in overvalued companies. An overvalued company is a company whose stock price is currently trading at a value that is higher than its true intrinsic value. That is, its value is somewhat inflated. And as the market corrects itself over time, an overvalued company's price or value should decrease. As mentioned before, The price earnings ratio is a good comparing metric. Thus, as an investor, you should compare the price earnings ratio of the company that you're interested in with other companies within that industry. And if you calculate a price earnings ratio that is less than the industry average, that could possibly mean that the company that you're looking to invest in is undervalued. And an undervalued company is a good investment option because its price or value is likely to increase in the future. The final metric we'll have a look at is dividends. The way a company treats dividends is important because it indicates what stage the company is likely to be in. A company that retains its dividends, i.e. does not pay out dividends and reinvest in itself, is likely to be in a growth phase, as opposed to a company that pays out a significant amount of dividends is likely to be in a mature phase. Although dividend income may seem attractive to an investor, it needs to be examined with precaution. A dividend yield that is too high could indicate that a company is not reinvesting in itself, which means that the company could be experiencing stagnated growth. And as an investor, you want to invest in a company that is likely to continue to grow in the future, because increased growth translates to increased profits, which eventually translates to a higher stock price. And there you have it, 5 key metrics to have a look at when investing in companies or looking to invest in companies. Of course, these are just the basis of your analysis when looking to invest. So I hope you enjoyed this video and found it insightful. As we end off, I always like to ask you guys to like, subscribe and comment. Thank you.